Faraday Future Intelligent Electric, FFIE, or FF for short, is a California-based company that markets themselves as designing and engineering next-generation intelligent, connected electric vehicles. It manufactures vehicles at its facility in Hanford, California, with additional production capacity through a contract manufacturer in South Korea. The company also has operations in China and plans to expand there. As a holding company, FFI conducts its operations through subsidiaries, with the majority of operations in the U.S. currently. However, there are risks associated with the company's current operating presence in China and potential expansion there due to political and economic influence from China. In recent years, this company has garnered growing coverage due to a polarizing mix of optimistic outlooks on its technology and promise plans, while also attracting severe criticism for the way the business operates and the extensive exposure to risk it is constantly under. Starting on the bright side, supporters and investors believe FF has developed several technology innovations, such as the Variable Platform Architecture, VPA, which FF explains allows for a flexible modular design accommodating various motor and powertrain configurations across multiple vehicle programs, leading to reduced costs and time to market while offering competitive differentiation. The VPA is meant to be a flexible skateboard-like platform that houses critical electric vehicle components. This adaptable structure allows for various wheelbases and battery pack sizes, supports different motor configurations, and can be configured for FWD, RWD, or AWD, enabling the VPA to allow for scalable vehicle design, improve manufacturing flexibility, reduce development time, and safety performance across product generations. They also promote their AI technology that is meant to offer high-performance computing, internet connectivity, OTA updates, and an open ecosystem for third-party application integration. Something made possible due to being built on an enhanced Android automotive codebase and is upgraded with each release of Google's platform. All FF vehicles use their proprietary FFIE unique identifier to deliver personalized content and experiences across the FF ecosystem. The II system utilizes an automotive-grade dual-chip computing system running on the Android automotive operating system, with continuous software updates for firmware, OS, middleware, and apps. The patented Future OS allows multiple users to log in and tailor their experience based on cloud-based FFIE profiles. Their ADAS technology offers various autonomous driving features through partnerships and future development, while also focusing on providing a personalized user experience across all vehicles through HMI options, third-party app access, and content aggregation. As for FF's propulsion system, it features an industry-leading inverter design and proprietary drive propulsion technology. This includes their FF Echelon inverter, which allows for high efficiency and low inverter losses. Their electric motor drive units are fully integrated with the inverter, transmission, and control unit to provide high torque accuracy and fast transient response. Motor drive units also offer a compact and efficient design with low noise and vibration, improving driving experience. FF completed upgrades to the FF91 futurist vehicle, improving its powertrain, battery, charging system, chassis interior, and overall performance. Progress on the FF91 and other models is driven by hundreds of patents, including several crucial ones relating to inverter assembly, integrated drive and motor assemblies, and a keyless vehicle entry system with facial recognition, along with an autonomous parking technology using multiple sensors. The company has chosen what they refer to as a B2C, business to consumer, passenger vehicle pipeline consisting of the FF91 series, FF81 series, and FF71 series. Each series targets different segments with multiple configurations, including limited edition models. The flagship FF91 series competes with luxury vehicles like Maybach, Bentley Bentayga, and Lamborghini Urus, while the FF81 series aims to compete against Tesla Model S and X, NIO ES8, and BMW 5 Series in the premium market, and the FF71 series is positioned to compete against Tesla Model 3 and Y, BMW 3 Series to target a mass market. FF states all vehicles share common brand DNA of intelligence, internet connectivity, modern design, superior driving experience, and personalized user experience. The first generation of FF vehicle series, FF91, features a domain-centralized electrical/electronic E/E architecture that offers flexibility, performance efficiency, and reduced complexity. This architecture consolidates functions into 5 high-performance domain control units (DCUs), managing propulsion, chassis, self-driving, body, and IOV systems. The E/E architecture can accommodate evolving autonomous systems' power and communication needs. All DCUs support over-the-air updates and data collection. With FF's 91 2.0 model, there is the introduction of the FFAI Hyper 6x4 Architecture 2.0, which combines 6 technology platforms with 4 technology systems. Faraday Future has a hybrid global manufacturing strategy consisting of its refurbished manufacturing facility in Hanford, California, and a collaboration with South Korean contract manufacturer Myeongshin. They are also exploring other potential contract manufacturing options and possibly manufacturing capacity in China through a joint venture or other arrangement. Earlier, FF has leased a 1.1 million square foot manufacturing facility in Hanford with an expected production capacity of approximately 10,000 vehicles per year and entered into a 9-year contract manufacturing agreement with Myeongshin for the production of their second vehicle, the FF81. In regards to distribution, FF uses a direct sales model with both online and offline sales channels for its passenger vehicles, which were launched in the U.S. in 2023, with potential expansion into additional markets. The company plans to establish cell-phone stores and partner-owned stores and showrooms for their distribution network. FF touts their marketing and sales approach called co-creation. It emphasizes that this approach goes beyond simple collaboration by centering users in all their endeavors, which helps the company to stand out in the EV landscape. Through collaborative partnerships with co-creators, FF aims to access substantial value across various aspects like product development, technological advancement, brand amplification, trust and loyalty, pricing power, strategic positioning, and brand marketing. This approach is said to not only make their offerings technologically superior, but also ensures they resonate with customers' evolving expectations and aspirations. The main objective with co-creation is to establish a direct and reciprocal relationship with customers, as opposed to traditional one-way methods. This is supported by several new initiatives such as leasing programs, mobile service fleets, home charging installation, public charging programs, and advanced service capabilities, which all aim to enhance customer experience and build brand awareness for FF's flagship model, the FF91 2.0 Futurist Alliance. FF has entered into several agreements and partnerships for strategic cooperation in engineering, technology, supply chain, and contract manufacturing. In February 2022, they signed a contract manufacturing agreement with South Korea-based Myeongshin Company, Limited, to produce the FF81. A potential partnership with Jejong Geely Holding Group Company was also explored under a non-binding memorandum of understanding in December 2020. Additionally, FF has engaged various companies for after-sales service systems and support, including Summit Solutions, KPIT, a U.S.-based national automotive services provider, and Salesforce for servicing the FF91 in compliance with governmental agencies. In January 2021, FF entered into a cooperation framework agreement with Geely Holding to explore joint investment in technology licensing, contract manufacturing, and joint ventures. However, these joint venture and contract manufacturing projects are currently on hold. Lastly, in January 2023, FF signed a non-binding cooperation framework agreement with the city of Huanggang in China, aiming to promote their U.S.-China dual home market strategy by relocating their FF China headquarters to Huanggang while maintaining global headquarters in Los Angeles. Establishing and maintaining agreements will become increasingly important as the luxury car market is projected to expand at a compound annual growth rate of between 8% and 14% through 2031. With 4 segments priced from $80,000 up to over $500,000 each expected to grow. Meanwhile, electric vehicle sales are estimated to exceed 65% of all passenger electric vehicle sales by 2030 in China and Europe due to policies promoting new energy vehicles and restricting internal combustion engine vehicle sales. By 2040, over 3/4 of all new passenger vehicles sold globally will be electric. On top of that, the cost of lithium-ion batteries used in electric vehicles has dropped significantly over the years, decreasing from $131/kWh in 2010 to an estimated $100/kWh by 2024. This trend is expected to continue with improvements in battery technology and manufacturing efficiencies. As a result, electric vehicle ownership costs should also decrease, leading to parity between electric and internal combustion engine vehicles by the mid-2020s. However, cost variations may occur depending on location. FF also cites the BNEF report, which predicts that shared mobility, including ride-hailing and car-sharing, will account for over 15% of total kilometers traveled by passenger vehicles globally by 2040, up from less than 5% in 2019. It also suggests that electric vehicles are anticipated to make up more than 75% of shared mobility vehicles by 2040 due to their lower operating costs. Though, this shift towards shared mobility may partially offset demand growth for personal passenger vehicles. To capitalize on these tailwinds, FF believes its dual home market strategy, innovative DNA, technology portfolio, and focus on design and personalized user experience will position it well in the passenger electric vehicle segments in the US and China. At the same time, they assert their platform has scalable architecture that enables them to capitalize on growing demand for light commercial electric vehicles, while their tech portfolio offers future licensing opportunities. Now, when talking about how the company is structured, FFI is a holding company with its main U.S. operating subsidiary, FFUS, incorporated in California. It manages its operations through subsidiaries. These subsidiaries are in China, including FF Automotive China Company Limited, Ruoyu Automotive Beijing Company Limited, and Shanghai Farron Automotive Technology Company Limited. Cash transfer between the parent company and PRC subsidiaries occurs mainly via capital contributions and dividends, following PRC laws and restrictions. Intercompany loans among PRC subsidiaries are also possible but require compliance with Chinese Banking Regulatory Commission rules. Furthermore, there are restrictions under PRC laws regarding foreign exchange and transfer of cash, specifically in relation to payments made by PRC subsidiaries to FFIE. Though certain procedures allow for payment of current account items without approval from SAFE or its local branches, while capital expenses involving currency conversion require approval. This is because measures can be taken by the PRC government to restrict access to foreign currencies and notes. New regulations may further limit remittance. Additionally, dividends can only be paid out of distributable profits, which are subject to statutory reserve requirements, potentially limiting the funds available for distribution to FFIE. As their operations expand, FF's PRC subsidiaries must obtain various licenses and approvals from Chinese regulatory authorities. So far, no applications have been denied. The company is also not currently required to obtain permissions from the CSRC or other Chinese authorities for previous offerings or listings, but may need to fulfill filing and reporting procedures in the future. There are uncertainties regarding compliance with these requirements, due to factors like new laws and proposed regulations that could further regulate securities offerings conducted overseas and foreign investment in China-based issuers. Overall, the main risks associated with FF's operations in China boil down to uncertainties due to the Chinese legal system, fluctuations in foreign currency that could impact the value of their securities, potential regulatory actions hindering business operations, complex procedures for acquisitions by foreign investors, evolving cybersecurity and data protection regulations, and difficulties in enforcing legal processes or conducting investigations in China. Yet despite these challenges, FF has achieved several significant milestones in its relatively short history, starting with completing test mule cars and developing a beta prototype in 2016. They obtained autonomous vehicle testing permits from California in 2016, debuted FF01 at CES in 2016, and revealed the luxury electric crossover vehicle FF91 at CES in 2017. In November 2017, they entered into agreements with their Series A investor to receive $800 million in financing. Then they completed the first pre-production build of FF91 in 2018 and began designing the FF81 project. In January 2021, they announced a business combination with PSAC and subsequently completed the merger, resulting in the combined company being renamed Faraday Future Intelligent Electric FFIE. Other milestones include completing the installation of pilot equipment at their Hanford, California facility in September 2021, starting foundation construction for all remaining production areas in December 2021, unveiling the first production intent FF91 EV in February 2022, and launching the ultimate AI tech luxury FF91 2.0 Futurist Alliance along with the eco-product AI Hypercar Plus in May 2023. Moving ahead, FF plans to offer purpose-built smart last-mile delivery (SLMD) vehicles by leveraging their proprietary technologies developed for passenger vehicles. They aim to provide tailored SLMD configurations that meet customers' specific needs while reducing development costs and time. FF contends our technical solutions like advanced connectivity, over-the-air upgrades, third-party app integration, surround view cameras, and advanced autonomy capabilities are well suited for the rapidly growing SLMD market. The adaptive modular design of SLMD also enables additional use cases such as utilities and tradesmen with minimal extra investment or time. So far, FF manufactures its FF91 series vehicles in Hanford, California, with a capacity of approximately 10,000 vehicles annually. They employ traditional vehicle manufacturing methods such as body assembly, paint operations, final assembly, and end-of-line testing. Their engineering and manufacturing teams work together for rapid product enhancements and quality improvements. Virtual manufacturing simulation methods are utilized to validate processes and improve efficiency. Increased production capacity can be achieved in Hanford or through outsourcing. The FF81 will be produced by a contract manufacturing partner in South Korea to accelerate the go-to-market strategy, while the FF71 may be produced by partners in South Korea, China, or elsewhere. This approach aligns with their hybrid, flexible manufacturing strategy. Since initiating delivery of the FF91, they've employed their direct sales model that combines online and offline channels. Their offline network includes self-operated experience centers and partner-owned experience centers, acting as showrooms for FF's models while also providing sales, after-sales services, and charging facilities. All purchase transactions are processed online but supported by FF partners who provide demonstration drives and vehicle information. As the company establishes its reputation, they expect an increasing share of sales to be completed fully online. For servicing, FF has partnered with third-party service centers, mobile service vans, and a national automotive services provider. They have also developed systems for repair orders, warranty, parts catalog, and repair manuals through Summit Solutions (KPIT). Their delivery plan consists of 3 phases. The first launched in May 2023, delivering vehicles to industry expert futurist product officers. The second, launched in August 2023, invited FPOs to purchase the vehicle and receive comprehensive training. And the final phase, making the FF91 available to all users. Then, in regards to competition, FF points out it competes with established and new automobile manufacturers that are entering the alternative fuel and electric vehicle market, such as Tesla, Porsche, Mercedes, Rolls-Royce, Audi Neo, Xpeng, Li Auto, Lucid Motors, Canoo, and Fisker. FF states they compete directly with other pure-play electric vehicle companies targeting the high-end segment while also competing to a lesser extent with new energy vehicles, NEVs, and internal combustion engine (ICE) vehicles in the mid to high-end segment offered by traditional OEMs. The main competitive factors include pricing, technological innovation, vehicle performance, safety, reliability, user experience, service and charging options, design, styling, interior materials, and manufacturing efficiency. Although FF has less resources than its competitors, it believes it can compete favorably based on the aforementioned factors, but recognizes that they may need to invest heavily in marketing and customer acquisition efforts. FF plans to invest significantly in establishing both online and offline marketing, sales, and after-sales channels consisting of its own stores, partner stores, showrooms, and an online web platform. They aim to distribute vehicles through direct stores in key markets while also having a distribution model of direct sales and partner-owned stores and showrooms in other markets. This strategy carries significant risks and uncertainties as they compete with established automakers and face challenges such as obtaining permits, addressing dealer trade associations, and ensuring customer satisfaction. Furthermore, FF still lacks sufficient liquidity to pay outstanding obligations and operate their business. They've incurred significant losses and negative cash flow since inception, raising constant doubts about their ability to continue. Revenue is still low and slow to grow, while there's still a reliance on capital from investors for operations. Due to lack of sufficient cash, inability to generate cash through ATM or registration statement, and limited remaining authorized shares, FF may have to file for bankruptcy protection if they can't access additional capital. The company has failed to make rental payments on all its leased properties, potentially putting it in violation of its insurance obligations under these leases. FF operates from 5 California facilities and 3 Chinese ones for various purposes such as manufacturing, retail, office services, etc. Due to this situation, the company is taking measures like negotiating with landlords for rent reduction or deferral, terminating some leases, or discontinuing payments. This could result in legal, financial, and reputational risks. There are no assurances that FF will receive any lease forbearance, nor can they guarantee compliance with their obligations. If leases get terminated, FF may not be able to continue vehicle production, again leading to the possibility of having to file for bankruptcy protection, resulting in asset liquidation, leaving equity holders with no recovery. Moreover, initial deliveries of their FF91 series may not be enough to generate sufficient revenue due to factors like competition, economic conditions, regulatory changes, and other risks. Add to that the uncertainty of more funding, which makes estimating a break-even point difficult, resulting in the development of other planned vehicles being delayed or reduced to lower capital requirements. FF's operating results forecast is largely dependent on management assumptions and analyses, which may prove incorrect. The company requires significant capital to fund operations, particularly in a capital-intensive industry. Its ability to secure sufficient funding, manage growth, maintain key supplier relationships, attract qualified personnel, and meet customer demand are critical factors affecting the accuracy of its forecast. Economic stability, regulatory changes, competition, marketing efforts, and consumer spending habits also play a role. Any discrepancies in these factors could negatively impact FF's business and financial results. Reaching sustainable profitability is made difficult by expected increases in operating costs. Factors such as R&D expenses, capital expenditures, raw material costs, logistics, and currency fluctuations could impact their ability to control costs and maintain healthy margins. Additionally, FF's plans to develop new vehicle models, expand manufacturing capacities, build inventories, and increase sales and marketing activities may result in higher costs than anticipated. To contend with higher costs, FF implemented an expenses reduction plan in December 2023, resulting in a decreased workforce from 499 to 288 by May 14, 2024. However, this strategy may lead to unintended consequences such as loss of expertise, lowered morale, and difficulty achieving desired benefits. Moreover, FF might struggle to redistribute the duties of departed employees or face issues ramping up production. Overall, FF has had substantial debt in the past and may incur more in the future to support its operations. This potential additional debt poses risks such as limiting its operational flexibility due to increased obligations for servicing debt, exposing it to fluctuations in interest rates and exchange rates, restricting its ability to borrow further or pay dividends, and increasing financial constraints, leading to banks, financial institutions, individual lenders, and governments that may have concerns or take actions that could affect cost, availability of credit, liquidity, access to capital, and overall operation. On top of that, FF has taken remedial measures in response to findings from a special committee investigation, which revealed inaccurate statements made by or on behalf of FF, deficiencies in internal control, and enhancements needed for certain policies and procedures. However, there is no guarantee that these remedial measures will be successful or fully implemented due to corporate governance agreements with FF Top and FF Global, as well as changes to the board and management structure. The special committee's findings have led to alterations in the remedial measures and precluded their full implementation. Despite ongoing evaluations of the remedial actions, there is no assurance that they will be successful or fully implemented. FF is facing an SEC investigation and various lawsuits related to the matters investigated by the special committee. These investigations may lead to financial damages, fines, penalties, increased costs, and management's time being diverted to handle legal proceedings. Additionally, there are ongoing legal actions against several officers, directors, and advisors of FF. The outcome of these investigations is uncertain, potentially causing significant professional service expenses and negative effects on the company's operations and reputation. Other concerns relate to logistics and how FF relies heavily on single-source suppliers for many components. This dependence exposes FF to potential delivery failures or component shortages due to supplier constraints or issues. Further delays can occur if suppliers stop doing business with FF due to late payments or other disputes. Efforts are being made to manage these risks, but there is no guarantee that alternative suppliers can be secured promptly or at acceptable terms. Another criticism against FF relates to them choosing to protect some of their technologies as trade secrets instead of applying for patents. This approach carries risks, including the possibility of not being able to file a patent application if someone else has already done so on the same subject, or facing potential infringement charges if someone else's patent application is granted and they continue using their technology. These risks are especially significant given the high volume of patent filings in their industry. Additionally, relying on trade secret protection can be problematic as there is no guarantee that efforts made to keep them confidential will succeed, and it may be difficult to detect or prove cases of misappropriation in court. In addition, factors like government support, subsidies, and policies for electric vehicles can change, which may negatively affect FF's business. Discontinuation of subsidies or new taxes could harm their competitiveness compared to other companies who have already launched electric vehicles. There is no guarantee that current tax incentives will continue. Now, a unique characteristic to consider involves Yuding Jia, as FF's founder and chief product and user ecosystem officer, is closely associated with the company's image and brand. His activities, media coverage, and public perception can impact FF's reputation, ability to conduct business, relationships with management and employees, fundraising capabilities, and relationships with government and regulatory officials. Past incidents involving Mr. Jia, such as his discipline within FF, personal bankruptcy declaration, and bans from various stock exchanges, could generate negative perceptions about him and potentially affect FF. However, if Mr. Jia were to disassociate from FF, it could also harm the company's business, operations, brand management, employee relations, customer relationships, and ability to develop business in China. Add to that, the board has determined that Mr. Jia is both a Section 16 officer and an executive officer of FF under Rule 3B(7) of the Exchange Act, which could adversely affect the outcome of the pending SEC and DOJ investigations of FF in connection with the matters that were the subject of a special committee investigation. Furthermore, as a result of Mr. Jia's regulatory sanctions in China, this determination could result in the delisting of FF securities by Nasdaq, which would negatively impact ongoing financing efforts, business and financial position, and materially impair the market for and market price of Class A common stock and warrants. In addition, if FF securities are delisted by Nasdaq, raising sufficient additional funds may become challenging, potentially leading to delays in production and delivery plans for the FF91, reduced headcount, asset liquidation, bankruptcy, reorganization, merger with another entity, or cessation of operations. Mr. Jia maintains that litigation previously initiated by FF Global to change the board and management of FF, which has since been dismissed without prejudice pursuant to the heads of agreement, was a collective decision made by FF Global and not his own. The interests of Mr. Jia, FF Global, and FF may not always coincide, especially in situations where the board prioritizes objectives or strategies that Mr. Jia or FF Global disagree with or consider unbeneficial. In such cases, Mr. Jia or FF Global could leverage their significant influence over FF shareholders and potential investors, management, business operations to advance their interests even if it negatively impacts FF. It goes without saying these issues are quite serious, especially since a substantial part of FF's future financing is anticipated from Chinese investors, but this investment may be delayed due to thorough due diligence reviews including anti-money laundering and know your customer processes. This review process has been particularly time-consuming for Chinese investors. In general, FF has identified material weaknesses in its internal control over financial reporting which could lead to material misstatements in their financial statements. These issues might impact their ability to accurately report their financial condition or operation results, affecting business operations negatively. FF's management is responsible for establishing adequate internal controls, but they've determined these were ineffective in the past. Efforts are being made to fix the weaknesses, but it may take longer to fully remediate. The cost and time consumption of these efforts could impact their financial resources heavily. Despite measures taken, there's no guarantee these will prevent future material misstatements or control deficiencies from arising. Delays in disclosures could result in legal consequences, including lawsuits and investigations. Also, further changes in key personnel might cause inconsistencies in financial reporting. FF is facing risks due to the restatement of its previously issued consolidated financial statements for the years 2022 and 2023. This may lead to potential legal disputes, loss of investor confidence, and reputational issues. Other risks include possible future errors and ongoing challenges related to the restatement process. Consequently, it's not too surprising FF has a history of not being in compliance with Nasdaq's continued listing requirements, including maintaining a minimum bid price for their class of common stock. They have received multiple notifications from Nasdaq regarding non-compliance and face the risk of delisting. If delisted, it could lead to the familiar issues involving the market price and liquidity of FF stock, making it more difficult to raise additional capital or issue new securities in the future. If FF attempts to implement a reverse stock split to remain listed on Nasdaq, it could negatively impact the price of its common stock. Although there is no specific limit on the number of reverse stock splits for compliance with the minimum bid price requirement, consecutive splits may erode investor confidence. Nasdaq may decide not to maintain FF's listing even if they regain compliance. Another reverse stock split would cause them to exceed the 1 to 250 ratio, potentially leading to non-compliance with other Nasdaq listing requirements. A delisting could harm trading liquidity, affect financing opportunities, and damage investor confidence, possibly resulting in a decline of the class of common stocks price and investors losing their investment. FF may issue additional common or preferred stocks, which could dilute existing investors' equity interest and affect market prices if substantial shares are sold. This potential dilution comes from various sources like conversions, exercises, RSUs vesting, earnout shares issuance, registered shares, and future financings. FF has also granted certain investors preferential director nomination rights, potentially causing it to fall out of compliance with Nasdaq listing rules. The company is actively raising additional capital for its operations, which may result in further dilution of existing stockholders' equity interests. These arrangements could lead to non-compliance with Nasdaq's Rule 5640, providing another possible reason for delisting from the exchange. So while Faraday Future raises optimism on the technology side of things, it has some serious issues on the business side. For more on Faraday Future and other companies, follow Ascencore. Thanks for watching and have a nice day.